when it might be bad to be prudent. Hi, my name is Gary Mishers. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So you might be thinking, like, how could it be bad to be prudent, Gary? What are you crazy? Have you been buying some meme stocks lately? What's going on? No, trust me, I haven't been buying any meme stocks. Don't worry. However, here's what I mean. I'm a big fan of studying history, and probably the investment book I've read the most is Ben Graham's Security Analysis. I use it to teach my course. I use it to mentor investors that I work with, and I've learned from it more and more every time I reread it every several years. And by the way, it's not a small book, so it's not like you read it on the beach or anything like that. But it helps me, read it, gain a few years of experience, read it again, and so forth. The context of security analysis, for those of you who don't know, is that it was written by Ben Graham in, I think, 1934 or 1933. I think 1934, right after the Great Depression and the big stock market crash. And so the interesting thing, the context that leads up to this book is that in the 1920s, and I don't remember every detail. I was young back then. I'm kidding. I wasn't alive back then. But the context was that basically you had people, mostly prudent, right? After World War I, people stayed prudent and they kind of invested in a very business-like fashion. And then the Roaring Twenties happened, right? And so what happened is that people, as the 20s progressed, started getting a little bit less careful, a little bit more speculative, and so forth. And most people held out for a while, right? And then what happened is, so let's say you're one of these people in 1920s and you're holding out and you see, maybe you live in a block with 20 neighbors, and then one of these 20 neighbors, starts getting a little bit extended in the margin debt and talks about how they basically, been making some extra money in the stock market, and maybe they can buy themselves something nice and, so forth and so on. And then you hold out and, you don't do that. And then some time passes and another neighbor succumbs, and now there's two people who are enjoying the free money they're making from the stock market, and then three, and then four, and then five. And let's say you're like the last one, one of the last few to held out. Maybe there's 15 people in this block that now are just like crushing it. They're buying all these things with their stock market proceeds. Now your spouse is starting to say, "Hey, listen, what's going on? Joe over there is minting money. John over there is doing great. Like, how come we can't get on this and make some money? And it seems easy. There's what you can't lose. Stocks only go up, right?" And this was the mentality of the 20s, right? Because for a while, people were cautious, and then they said, "Well, where's the risk? There hasn't been a downturn in so many years, and the stocks are doing so great." And by the way, isn't there an economist that just published this book? Said something arguing about the new permanent plateau of productivity or wealth or something like that. Very famous economist. So we have nothing to worry about. It's fine. Why don't we make some money and put our savings into the stock market, maybe get a little margin just to get a little feel for it, right? And so let's say you're like the last one, right? And it's like 1929, and you held out for a number of years as all this speculative kind of juices are flowing, bubbles are bubbling, and you said no, no, and no. But finally, 1929, you say, "Okay, fine. Clearly I was wrong. I've been prudent all these years. I'm finally going to go put money into the market, lever up, and bet on these exciting radio stocks. RCA here is on a tear; it's going higher." So the Wall Street brokers tell me. They didn't have Reddit back then, so they didn't get their stock tips from random retail investors in an anonymous fashion. They actually had to get brokers to give them advice. But nonetheless, so bear with me. I know it's a little old-fashioned nowadays. And let's say you were like the last person to succumb in 1929. Well, here's the problem. If you were the last person to succumb, you're actually worse off than all your neighbors, because you still lost like a huge portion of your money, 80, 90% of your money in the crash. Especially if you use margin, you might have lost it all. But at least the other guys, the guys who lost their prudence early on, maybe they bought a new refrigerator or whatever, took a nice vacation with some of the proceeds. So at least they got, to enjoy that money for a bit before they got wiped out. You were prudent all this time. you held out, you held out, you held out, and then you gave in. And it's kind of like showing up to a party, right? Let's say, we have the COVID pandemic. Everyone is tired of it. They want to start partying again. I'm not saying you should, make your own decisions on that. But let's say you prepay $1,000 to go to this amazing all-you-can-eat, all-you-can-drink party. Um, well, it's $1,000 if you show up late early. But it's kind of like, so losing your prudence in 1929 and finally going all in the market, kind of like paying the $1,000 and showing up like 5 minutes before the party is done. And you say, "Hey guys, I'm here. Where are the free drinks?" And they say, "Sir, sorry, we're closing down, but there's some old like watered down sangria over there. You can have that if you want, or maybe some water, but everything else has been packed away." And you're like, "But I paid my $1,000." But it's like, yeah, but party's over. And here's the thing: in the stock market, you just never know when the party is going to be over. And the returns the markets, especially in the U.S., have enjoyed over the last few years are certainly not sustainable. Whether there will be a crash or not, I don't know. But history suggests when you have a period of excess and margin debt is rising, and a lot of these speculative behaviors that we're observing, the reaction is not slow and gradual, but rather sudden. That's the history. Doesn't mean it has to be that way. It certainly doesn't mean we know when it's going to end, but there's a good chance that it will end badly. And so, if you held out this far, I would like urge you to think: do you want to be that person who holds out almost until the end and then joins the speculative excesses at the last moment and doesn't even get to enjoy them that much before they get seriously hurt financially? Um, because if you were going to do that, you might have as well have thrown your prudence to the wind and just like got in early on some of these things and enjoy the ride a bit, and so forth. So I'll let you decide what you should do. I think that prudence makes sense. I know the title was a bit of a teaser. Sorry, guys, but I think if you were being prudent, stay the course. Don't change your mind now just because you see your neighbor is making easy money or some random person on the social media bragging about how they made XYZ money or how some stock is going up. And yes, you only live once, and that's awesome. But that doesn't mean you should lose your hard-earned savings on some speculative market activity. Uh, Remember how hard it is to earn that money. How what you had to do to get it. Be careful with it, whatever that means for you, and make sure you invest prudently as much as you can. I hope this has been helpful to you. If it has been, please hit like, and I'll see you in the next video. Take care.